Why do some people who look broke quietly become financially free, while others who look successful stay stuck? I've met professionals driving 10-year-old cars with fully funded retirement accounts and no consumer debt. I've also met high earners in brand new SUVs who feel constant pressure to keep up appearances. Same city, similar income, very different stress levels. Over the past decade, lifestyle inflation has quietly become normal. Bigger homes, nicer cars, better vacations. Every upgrade feels earned. Every raise gets absorbed. And the number required to finally feel secure keeps climbing. Here's what most people don't see. The more expensive your lifestyle signals become, the less flexible your life becomes. This isn't about pretending to struggle. It's about control. When you spend to signal wealth, you raise your fixed costs and your social expectations. You build a life that depends on maintaining a certain income. But when you choose to live modestly, even intentionally looking poor relative to what you earn, you lower the number required for financial independence. You create margin, you reduce pressure, you attract relationships built on shared values, not visible status. So here's the real shift. What if the fastest way to feel wealthy isn't earning more, but needing less? In this video, we'll break down why keeping a low financial profile increases flexibility, how status-driven spending quietly erodes freedom, why modest living improves peace of mind and relationships, and how lowering your lifestyle baseline can bring financial independence years closer. And we'll start with the psychological trap most people never notice, why signaling wealth can quietly lock you into a treadmill that never stops. Escaping the hedonic treadmill. You finally get the raise. Maybe it's $8,000 more a year. For a few weeks, it feels like progress. You upgrade the apartment, you lease the nicer SUV, you start ordering out a little more often. Life looks better. Then 6 months pass. The raise feels normal. The payment doesn't. This pattern has a name, the hedonic treadmill. No matter how much income rises, happiness tends to return to baseline once basic needs are covered. Housing, food, healthcare, stability. After that, the emotional boost from spending fades fast. A 1978 study on lottery winners found that within months, their happiness levels returned close to where they were before the win. The number changed, the baseline didn't. You see this everywhere. A new iPhone launches. The camera is sharper, the screen brighter. For 2 weeks, it feels exciting. By month 3, it's just your phone. The same thing happens with cars. That first drive off the lot feels incredible. By year 2, it's transportation with a payment attached. And here's where it gets more subtle. Social media speeds up the treadmill. You're not just comparing yourself to neighbors anymore. You're comparing yourself to curated lifestyles online. Vacations look bigger. Homes look newer. Success looks louder. That quiet pressure nudges spending upward, even when income hasn't moved much. Meanwhile, surveys show that a large percentage of households earning 6 figures still report living paycheck to paycheck. The issue isn't income alone. It's adaptation. Every upgrade resets the standard. Looking poor, intentionally choosing not to signal every gain, breaks that cycle. When you don't escalate your lifestyle with every raise, your expectations stay stable. Your expenses stay predictable. Your satisfaction lasts longer because you're not constantly redefining normal. But the treadmill is only part of the story. The real structural danger isn't just emotional adaptation. It's what happens financially when one upgrade quietly triggers 5 more. And that's where things compound in the wrong direction. Avoiding the Diderot Effect and lifestyle inflation, you don't even have to buy the luxury car to feel the impact. Sometimes one upgrade is enough. Imagine someone gifts you a $250,000 sports car. Free. Sounds like a win. Until you realize insurance is 5 times higher than your old sedan. Premium gas only. Tires that cost thousands to replace. Annual servicing that runs $1,500 to $2,000. And if something breaks, parts can take months to arrive. The car was free. The lifestyle wasn't. This is known as the Diderot Effect. One new possession makes everything else look outdated. You upgrade the car, then the watch feels wrong. The watch changes, then the wardrobe feels off. The wardrobe changes, then the apartment doesn't match. What started as one harmless improvement quietly rewires your entire cost structure. Now, you see this in everyday life. A kitchen remodel leads to new appliances. A bigger home leads to higher property taxes, higher utilities, and more furniture. A promotion leads to private school considerations. Each step feels reasonable in isolation. Together, they create a permanent rise in fixed expenses. And fixed expenses are dangerous. A $900 car payment isn't just $900. It's pressure. It's the job you can't leave. It's the business idea you don't test. It's the break you don't take. Meanwhile, average household debt outside mortgages sits around $20,000 or more, much of it revolving credit. Lifestyle inflation feeds that number, not because income is low, but because standards keep rising. Looking poor interrupts that chain reaction. You avoid triggering the cascade. You preserve margin. Now you keep your baseline stable instead of constantly upgrading it. And once you stop escalating costs, something powerful happens. The gap between what you earn and what you spend begins to widen. That gap changes more than your balance sheet. It changes your options, increasing financial freedom and optionality. When the gap between what you earn and what you spend starts to widen, something shifts, not emotionally, structurally. If you earn $95,000 and spend $90,000, you look successful on paper. Nice apartment, new car, vacations, but you have almost no margin. One layoff, one medical bill, one market downturn, and you're negotiating with your future. Now compare that to earning the same $95,000, but living on $65,000. That $30,000 difference is not just savings, it's leverage. In 1 year, that's a fully funded emergency reserve. In 3 years, that's 6 figures invested. Over a decade, compounded in broad market funds, it becomes real optionality. Optionality means you can say no. No to the promotion that doubles your stress. No to the relocation you don't want. And no to the boss who assumes you need the paycheck more than your principles. And the moment you can say no, the dynamic changes. A large percentage of households report feeling stuck despite solid incomes. The issue isn't always earnings, it's the absence of breathing room. High fixed expenses trap people in survival mode. Even small recurring obligations, car leases, luxury memberships, constant upgrades, shrink flexibility. When you choose to look poor, you deliberately keep your lifestyle lighter than your income. You build cash reserves. You invest consistently. You redirect money towards skills and assets instead of signaling. And here's the quiet part most people miss. Freedom doesn't feel dramatic. It feels calm. It feels like knowing you could walk away, even if you don't. But freedom isn't only financial. When your lifestyle is restrained, something else changes too. The people around you start responding differently, and that shift matters more than most realize. Lowering stress and staying out of survival mode. When your fixed expenses rise, your stress rises with them, not always loudly, but constantly. If your monthly obligations total $7,500, mortgage, car payments, subscriptions, insurance, you don't need a crisis to feel pressure. You just need uncertainty, a rumor of layoffs, a slow quarter in your business, an unexpected repair. Recent surveys show that a majority of adults report financial stress, even among solid earners. It's not always about low income, it's about high commitments. When most of your take-home pay is already assigned, there's no room for error. Take a simple example. A luxury SUV might run $900 a month between payment and insurance. Add premium fuel and higher maintenance costs, and you're closer to $1,200. That's $14,000 a year tied to one asset that depreciates. I'd miss 2 paychecks, and that payment becomes heavy fast. Now contrast that with someone driving a reliable, paid-off car. Lower insurance, lower maintenance, no monthly note. Same transportation function. Very different stress levels. Stress compounds quietly. When you feel financially tight, you avoid risk. You don't negotiate salary. You don't explore side ventures. You don't take calculated career moves. You protect the paycheck above all else. Looking poor reduces the baseline pressure. Fewer obligations mean more stability. More stability means clearer thinking. And clear thinking leads to better long-term decisions. But there's another layer. When you stop signaling wealth, something changes socially too. The people drawn to you and the expectations placed on you begin to shift, and that has its own financial consequences. Attracting genuine relationships and filtering out the wrong ones. The way you present your finances changes the kind of people who move closer to you. When you signal visible wealth, luxury watches, high-end restaurants, constant travel, you don't just show success. You set expectations. Suddenly, group dinners are at 5-star spots. Vacations need to match a certain standard. Splitting a $600 table at a nightclub feels normal. At 24, that might just feel uncomfortable. At 35 or 40, it becomes expensive. There's a subtle pressure that comes with appearing wealthy. Friends assume you can afford more. Colleagues assume you'll contribute more. Even extended family may see you as the fallback solution during financial stress. None of that is necessarily malicious. It's just how signaling works. And sometimes it goes deeper. Studies have shown that a significant percentage of people admit to misrepresenting their financial situation in relationships. When wealth becomes part of your identity, it can attract attention based on status rather than character. Looking poor quietly filters this out. When you drive a normal car, wear simple clothes, and don't broadcast portfolio milestones, the people who stay around you are there for different reasons. Conversation shifts from appearances to ideas, from lifestyle comparisons to shared values. You begin to notice something else too. When you don't compete socially, you feel less pressure to keep upgrading just to fit in. Your financial decisions become internal, not performative. That shift matters more than it seems, because once social pressure decreases, so does the need to display. And reducing display does something practical beyond relationships. It lowers visibility. And lower visibility in a connected world reduces risk in ways most people underestimate. Reducing unnecessary external risk. When you display wealth publicly, you don't just change how friends see you. You change how strangers see you. Posting the new car, tagging the luxury resort, showing the watch collection. It feels harmless, but visibility scales fast. A photo meant for 200 followers can travel far beyond that circle. And here's the uncomfortable part. Visibility attracts attention, and not all attention is positive. Financial crimes have become more digital and more targeted. Identity theft, account phishing, and even social engineering scams often start with simple public information. The more someone knows about your lifestyle, the easier it becomes to craft believable approaches. A portfolio screenshot, a vacation schedule, a home renovation post. Each detail adds context. Even offline, signaling wealth can increase risk. Higher-end vehicles and visible luxury goods are statistically more likely to be targeted for theft. Insurance companies price this in. That's part of why premiums rise with status items. Risk isn't theoretical. It's built into the cost. And then there's reputational risk. Publicly showing gains during economic downturns can shift how colleagues or business partners perceive you. Quiet wealth avoids unnecessary friction. Looking poor doesn't mean hiding success. It means controlling exposure. It means not turning your balance sheet into public information. Most financially stable people I've observed share one trait: discretion. Their homes are comfortable but unremarkable from the outside. Their cars blend in. Their online presence is neutral. It's not fear-driven, it's strategic. And because when you reduce unnecessary exposure, you preserve not only money, but stability. And stability becomes especially important when you think about the long game, retirement. And here's where the conversation shifts. Living modestly doesn't just reduce risk today, it dramatically changes how much money you need tomorrow, making retirement easier and more attainable. Retirement is not about how much you earn, it's about how much you spend. Two people can both make $120,000 a year. One lives on $60,000, the other spends $100,000. Their retirement targets are completely different. Using the 4% guideline, if your lifestyle costs $50,000 a year, you need about $1.25 million invested to sustain that spending. If your lifestyle costs $100,000, you need $2.5 million. Same person, same earning power, double the required capital. That difference is not small. It can mean working an extra decade. And here's the part most people underestimate. Lifestyle tends to stick. If you normalize $9,000 a month in expenses during your working years, you'll expect something similar later. Downsizing is emotionally harder than upgrading. Yet living modestly while earning well does two things at once. It lowers your required retirement number and it increases your savings rate. That's a powerful combination. For example, if you save an extra $6,000 a year by avoiding constant upgrades and invest it consistently over 25 years at long-term market averages, the difference can easily reach hundreds of thousands of dollars. That's not extreme investing. That's basic compounding. Meanwhile, average non-mortgage debt levels hover around $20,000 or more, often carried on credit cards. High interest rates make it expensive. Keeping your lifestyle controlled makes debt manageable or avoidable. Looking poor is not about deprivation. It's about compressing your baseline. The lower your baseline, the less capital you need. The less capital you need, the faster financial independence becomes realistic. And once you see retirement as a spending problem, not an income problem, the entire strategy shifts. Key takeaways. Looking poor isn't about shrinking your life, it's about stabilizing it. When you stop upgrading every time your income rises, you step off the treadmill that quietly resets your expectations. When you avoid lifestyle inflation, you prevent one purchase from turning into five. When your fixed expenses stay controlled, stress drops, not because you earn more, but because you owe less. The real shift is structural. A modest baseline widens the gap between income and spending. That gap becomes flexibility. Flexibility becomes freedom. And freedom is what most people are actually chasing when they chase status. You also begin to notice something subtle. When you don't signal wealth, you reduce social pressure, reduce exposure, and attract people who respond to you, not your possessions. Your financial life becomes quieter, not but stronger. And perhaps most important, retirement stops looking like a massive number you have to climb toward. It becomes a math problem shaped by your lifestyle. The lower the lifestyle, the smaller the mountain gets. If this perspective resonates with you, the next step isn't to cut everything. It's to look at your baseline and ask, is it built for appearance or for durability?